In this video, we're going to take a look at the first of three different methods that we're going to learn about to value a stock. This is going to be the dividend discount model method. And we talked about the dividend discount model. We derived where it came from. Now we're going to actually use it to come up with the price of a fictitious stock with some fictitious numbers that are coming in here. So the point is that we understand the process, and then so that you can apply it to some real numbers later on. So let me bring up the class notes, okay, where we talk about this here. And this is on page 4 of the class notes. So the dividend discount model, okay, the first step you want to do is you want to look at the company. You want to look at the industry financials. You want to look at the macro economy as well. And this is the hardest part, okay, but you're not going to have to do this. You're going to project what you think the dividends are going to be for the foreseeable future. And the foreseeable future is probably not going to be any more than 5 years, okay? But however far into the future you can project these. And as I said, I'll just tell you what we expect the dividends to be. But that's really the hardest part is trying to project what the dividends are going to be, because a projection is really an educated guess. Then what you're going to do, okay, we're going to establish a terminal value. We're going to determine a terminal value for the stock at that point in time. In other words, at the point in time where you stop projecting individual dividends, that's where you're going to come up with a terminal value. If you project dividends for 4 years, you'll have a terminal value at time 4. If you project dividends for 5 years, you'll have a terminal value at time 5. If you project dividends for just 2 years, you'll have a terminal value at time 2. The terminal value is going to be, what do you think the price of the stock is going to be at that point in time? Generally, you come up with this through a simplifying assumption, which we talked about in the last video, that you say, for example, that I think the dividends are going to continue to grow forever at a rate of 3% or a rate of 2% or something like that. Or you think the dividends are going to just stay constant forever. Or in some cases, you might say that I think the stock is going to have a certain PE ratio at that point in time equal to what the industry is. And here's what I think that PE ratio is. So there's something that allows you, that you're allowing to say, hey, here's what I think the stock price is going to be based upon some sort of an assumption going forward at that point in time. So then all you have to do at that point is you have to discount all those cash flows back to time 0. When you discount all those cash flows back to time 0, you have to do it at the stockholders' required rate of return, or the expected return, which we are going to learn how to do that before the end of the course. But right now, we'll just give it to you. And as we said before, that's based upon the level of risk of the stock. More risky stock, higher required rate of return. So let's take a look at an example that we have for you with a fictitious firm called Freeman Corporation. And we're going to say that Freeman, based upon our research, is expecting some certain dividends over the next 5 years. Let me put this into the whiteboard, and then we'll come back to this in a second. Okay, so here is what we are expecting for the dividends for Freeman. Here's time 0, 1, 2, 3, 4, 5, and we'll go out to 6 here. And we say, hey, I think, based upon my research, that Freeman is going to pay a dividend of $3 here. And remember, dividends are actually paid quarterly, but we just make that assumption that they're paid annually to make life a little bit easier for us. And then $3 here, and then we think the dividend is going to be $4 here, and $4.50 there, and $5 there. And we say that's as far into the future as I can project what the dividends are. At that point in time, as an analyst, I'm going to say, I have to make a decision. Do I think the company is going to go bankrupt at that point in time? Then that's the end of the story. That's probably not what I'm forecasting. So I got to forecast there's got to be some dividends beyond then. Okay, I don't want to say 0, because that would cause me to very wrongly estimate what the value of the company is. So I'm going to come up with the assumption, the simplifying assumption that these dividends are now going to start growing at 3% per year forever. And this is a pretty common thing to do, to come up with a terminal value based upon a constant growth rate. So we're going to say G is equal to 3%. So that's going to give us a terminal value at time 5. In other words, the terminal value at time 5 is going to be, what do I think the stock price will be at time 5 based upon this assumption that the dividends are, starting at time 5, going to be growing at 3% per year forever and ever and ever. That's what how I get that terminal value at time 5. So the terminal value will always come at the point in time where we stop making the individual forecasts of these. Now, what is a reasonable growth rate to assume there? Why didn't I say growing at, say, 20%? Well, the reason why is we're saying forever at this point. No stock can grow at 20% per year forever. Okay. It can grow at 20% per year for 2 or 3 years, 10 years, maybe 20 years. Okay. That would be a lot. Okay. But it can't do it forever for a simple reason. A stock cannot forever grow faster than the economy. If a stock is forever growing faster than the economy, it overtakes the economy and it owns the world, okay? And that can't happen. So a stock cannot grow forever, okay? It can temporarily, but it can't forever grow faster than the economy. So you got to say, what's realistic for the world economy to be growing on a long-term basis? 4, 5, 6%, something like that. You can't have stocks growing faster than that. Secondly, is stocks cannot grow faster than this equation. In other words, the growth rate has got to be less than or equal to the ROE. That's the return on equity. That's the rate of return the company is generating on its reinvested money, multiplied by what we call the retention ratio. The retention ratio. And there's other names for that other than retention ratio, but that's what I call it. Okay. Some people call it the plowback ratio. But at any rate, when a company makes money, okay, has earnings, there's only 2 things it can do with the earnings. It pays them out as dividends or it keeps them as retained earnings. Now, let's suppose a company has $1 of earnings. Okay. So its earnings are $1. And if it pays out 30 cents as a dividend, okay, that means it's got 70% is keeping as retained earnings, which are owned by the stockholders, okay, 70 cents in retained earnings. So its retention ratio is going to be 70%. The company retains 70% of its earnings. Well, over a long time, on average, okay, way into the future, your retention ratio multiplied by ROE, that's a maximum on your rate of growth. It's just a mathematical thing, okay? So you cannot have long-term growth rate greater than your expected ROE times your retention ratio long-term. Also, it can't be growing faster than what the economy is. So there's some bounds on what those growth rates can be. So a growth rate of 2, 3, 4, 5% is probably pretty typical in there that we would see for long-term growth. Temporary growth can be much higher than that, but long-term growth really can't be. So this is what we're looking at with Freeman there in terms of the cash flows that we're expecting. And let's just say that as an investor who is looking at what is the level of risk in this stock and in the cash flows, I have determined that I require a 10% rate of return. So I'm not going to invest in Freeman unless I am going to get a 10% rate of return because of the level of risk of the stock. And knowing that I can invest in a U.S. Treasury bond, okay, or a U.S. Treasury note and get a guaranteed rate of return, okay, as long as there's a United States of America, I'm going to get this rate of return. So Freeman is not nearly that secure. So therefore, I'm going to require a higher rate of return than that because of the level of risk. Okay, so anyway, I'm requiring a 10% rate of return. Let's go back to our notes and see how we do the math on this. Okay, so here is how we're going to come up with the price of Freeman stock, or what we think the price should be. We're simply going to take the expected future dividends and discount them back at my required rate of return, which was 10%. So here's the dividend at time 1 divided by 1 plus R, where R is 10%. The dividend at time 2 divided by 1 plus R squared. The dividend at time 3 divided by 1 plus R cubed. The dividend at time 4 divided by 1 plus R to the 4th, and the dividend at time 5 divided by 1 plus R to the 5th. Now, at this point in time, that's all the individual dividends we forecast. But what we have to do now is come up with our terminal value, okay? Our terminal value is going to be at time 5. It is going to be, what do I think the price of the stock is going to be at time 5, okay, based upon the fact that I think the stock is going to be growing at 3% per year forever after that. So let's go back to the whiteboard for a second. And we say, here's my terminal value at time 5. And my terminal value at time 5 is going to be equal to my dividend at time 6 divided by R minus G, based upon my growing perpetuity formula. Remember, the present value of a growing perpetuity at time 0 is equal to the cash flow at 1 divided by R minus G. So therefore, the present value at time 5 is equal to the dividend at time 6 divided by R minus G. So what is my dividend going to be at 6? Well, I only forecasted up to 5, but hey, my dividend times 6 should be 3% more than my dividend was at time 5, right? Because that's what I'm saying. It's going to be growing at 3% forever. So that's going to be equal to 5 times 1.03, okay, which I think is like $5.15. I think the dividend at time 6 is going to be 3% more than what it is at time 5. And I already said that I think it's going to be $5 at time 5. So there's my dividend at time 6. R is still my required rate of return of 10%. That's not going to change. So that's 0.1 minus, and here's my growth rate again of 3%, 0.03. And we said you have to have an R that's greater for your growth rate than your growth rate in order for this thing to be able to work. So now I just do the math, okay? $5.15 divided by 0.07 ends up being $73.57. $73.57. So that's my terminal value at time 5. So now what I need to do is I need to bring this back to time 0, 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 and the terminal value at time 5, which is what I think the price of the stock is going to be at time 5. Bring that back to 0. Oh, and before I forget, also this dividend at time 5 needs to be brought back. So these 5 dividends need to be brought back, plus the terminal value at time 5. So if we go back over to our class notes, we will see this, okay? Here was my 5 dividends being brought back to time 0. Now notice the tendency here is to say the exponent is 1, 2, 3, 4, 5. Here it should be 6, but it's not. The price at time 5 to get back from time 5 to time 0 means we have to discount it back 5 time periods. And the price at time 5, we just said, we think it's going to be $73.57. So you do the math on this, and you end up getting that the price at time 0 is going to be $60.07. Now let's review this and make sure we understand what we mean by this. It means I think what the stock is worth today, based upon the dividend discount model, is $60.07. If I see the stock trading for an amount above $60.07, I think it's too high. Okay, I wouldn't buy the stock. If I see it priced at below $60.07, I would say, hey, I think it's actually worth more than that. If I see it trading at $50, I say, hey, I think it's worth more than that. So I would want to go and buy the stock. And if I see it priced at $60.07 exactly, well, let's see what happens. If I pay exactly $60.07 for the stock, and if all my forecasts come true. Now, this will never happen in real life. Okay. All your forecasts won't come true, but let's just say they do. Let's suppose it actually pays out a dividend of $3 in year one, $3 in year two, $4 in year three, et cetera. And let's suppose that at time 5, in fact, its price is $73.57 because the stock grows at 3% per year thereafter. So miraculously, all of these projections have come true. Okay. And I paid $60.07 for the stock. My question is, what is the rate of return I have earned on my investment? Think about that for just a second, and while I review that. I paid $60.07 for the stock, and in fact, it paid $3, $4, $4.50, $5 in dividends, and then at time 5, it was worth $73.57 because it continued to have its dividends grow at 3% per year forever. If all that actually did happen, okay, and I paid $60.07 for the stock, what was my rate of return? Well, the answer is the rate of return was 10%, because that was how we came up with $60.07. We said, if all of those things come true, if those dividends come true exactly as projected, and then the price at time 5 is $73.57, and that in order to get a 10% return, we needed to have it priced at $60.07. That's what we did when we discounted it all at 10%. Discounting all this at 10% said, in order to earn that 10% return, what does the price need to be? Well, it needs to be $60.07. So if I could buy the stock for less than $60.07 and all this comes true, then I will have earned more than a 10% rate of return. But if the stock costs more than $60.07, okay, and all of this comes true, I will have earned less than a 10% rate of return. And I started out by saying my required rate of return based upon the level of risk of the stock is 10%. So I'm not going to pay more than $60.07 because I don't expect to earn a 10% rate of return if I pay more than $60.07. Now, it may turn out that I'm wrong in terms of my projections of the dividends. Maybe they'll pay a lot more dividends than what I thought, okay? But at time 0, these are my expected dividends. So if I pay $60.07, then I expect to get that 10%. If I pay more than $60.07, then I would be expecting at least at time 0 to get a less than 10% return. And I started out by saying that's unacceptable to me because that's too low of a return for the level of risk of this particular stock. Now, when we are making these projections on the dividends and so forth, 2 numbers are particularly important because if you're off on these numbers, or if you change these numbers, it will change the price that you are saying the stock should be trading at drastically. Let me show you as an example. Let's suppose instead of projecting a 3% return forever, we only project a 2% return forever. In other words, I'm still projecting the dividends are going to be these numbers for the next 5 years. Okay, I'm not changing that projection at all. I'm still requiring a 10% rate of return. But now I'm saying at the end of 5 years, okay, I think the stock is going to grow at 2% instead of at 3%. How much of a change does that make in the price of the stock? A big change. And now, instead of thinking the stock is worth $60.07, I think it's worth about 10% less than that, $53.97. So that 1% change in my terminal growth rate, okay, my long-term growth rate is going to make a 10% change in the price in this particular example. So what number you attach to the dividend at time 2 or 3 or 4 is not nearly as important as what you are projecting the long-term growth rate to be. That's a very important number. The other very important number is the discount rate. Let's suppose instead of requiring a 10% return on the stock, you require a 12% return. So all of the dividends are still the same thing, and the growth rate is 3%, All the projections are the same, but I'm now saying, I think the stock is a little bit riskier than I had thought. So I'm going to require a 12% rate of return rather than a 10%. Well, now the price of the stock goes down to my what I perceive to be the fair price of the stock goes all the way down from $60.07 to $46.09. That's a huge drop in there. Okay. That's like, 15, I don't know, 15, 20%, something in there. So you got a gargantuan drop in the price of the stock. Yeah, I think it's 20% drop in the price of the stock because I require a 12% rate of return rather than a 10%. So the two most important numbers you want to take a look at here are going to be the long-term growth rate and the required rate of return, where people tend to focus a lot on, well, what do I think this dividend is going to be a year from now? What do I think it's going to be 2 years from now? And those are worth spending some time on, but they're not nearly as important. They don't play nearly as big a role in determining the current price of the stock as the discount rate and the long-term growth rate do. Okay, so there was an example of using the dividend discount model to come up with the price of a stock. The other two methods we're going to take a look at, we will explore in the next video.